Imagine watching a massive company stock just completely plummet by like 97%. State regulators are pacing the halls. They're threatening to shut the entire operation down.
Right, total panic.
Exactly. Wall Street is running for the hills, dumping shares as fast as humanly possible. And Warren Buffett looks at this burning wreckage, this absolute financial disaster, and decides, well, this is the perfect time to bet my fortune.
It sounds insane, honestly.
It really does. I mean, welcome to the deep dive, by the way, because today we are doing exactly that. We are unpacking the ultimate blueprint for building wealth.
Straight from the source material.
Right, straight from the source material, detailing Warren Buffett's most pivotal deals. Because people tend to think building a billion-dollar empire is about, inventing a perfect, shiny new engine from scratch.
Which is almost never how it actually works.
No. The reality of real wealth creation is far messier. It's more about walking into a junkyard, finding a rusty, half-broken engine, and realizing that one specific gear inside is actually made of solid gold.
I love that. That is the perfect way to frame it. Because the neat, linear narratives we usually hear in hindsight, they completely obscure the terrifying, seemingly illogical risks that actual wealth creation requires.
Yeah, we look at the final product and assume the blueprint was just flawless from day one.
But to set the stage for you today, it is really important to understand that we aren't looking at Buffett, the multi-billionaire, folksy grandfather figure today.
Right, totally different era.
Exactly. We're looking at a 40-something Warren Buffett in the 1970s. At this specific point in time, he has just crossed the $100 million mark.
Which is obviously a lot of money.
Oh, undeniably successful. But he is not yet the global, undisputed icon of investing. So the profound question we're answering today is, how exactly did he take that $100 million and turn it into his first $1 billion by the end of the 1980s?
A 10x return in a single incredibly turbulent decade. And to figure out how he achieved that, we are extracting the mechanics behind three very specific acquisitions: GEICO, the Buffalo Evening News, and the Nebraska Furniture Mart.
Three very different businesses.
Super different. But our mission is to understand the secret, the underlying economic franchises that propelled Berkshire Hathaway stock from around $89 to over $2,600 in just 10 years. Okay, let's unpack this, starting with that burning wreckage we mentioned. The deal Buffett himself called probably the single best investment he ever made.
GEICO.
So what happened there?
Well, to understand why GEICO collapsed so spectacularly in the mid-70s, you first have to understand the sheer genius of their original foundation.
Okay.
GEICO was built on what we can call the operating cost virtuous circle. Because think about it, the insurance industry is notoriously brutal.
Right, it's just a pure commodity.
Exactly. You cannot charge a massive premium for car insurance simply based on brand loyalty. Customers ultimately just want the lowest price. And most insurers in the mid-20th century paid massive commissions to middleman agents.
Like local brokers and stuff.
Right. That meant sometimes 40% of the money they took in went straight out the door to administration and sales commissions. GEICO simply bypassed all of that.
They just cut them out.
Cut them out entirely. They sold directly to the customer via mail and telephone.
And they combined that direct-to-consumer model with a fiercely protected target audience, which, is where the name comes from, Government Employees Insurance Company.
Yes.
By targeting government and military personnel, they were inherently selecting this pool of low-risk, responsible drivers with very steady, predictable incomes.
And that combination was lethal to competitors, because they had almost zero acquisition costs and a pool of incredibly safe drivers filing far fewer claims.
So their internal costs were just microscopic?
Microscopic. They took those massive savings and passed them directly back to the consumer in the form of rock-bottom premiums. Lower premiums attracted even more safe drivers, who then recommended GEICO to their friends, which lowered acquisition costs even further.
It was this flawless, self-perpetuating flywheel.
Until they decided the flywheel wasn't spinning fast enough.
Right, the classic growth trap. Because you read the source material from the early 1970s, and the executives decide to just open the floodgates.
Yeah, they got greedy.
They start underwriting blue-collar workers, drivers under 21, basically demographics with vastly different risk profiles and much poorer accident statistics.
And they assumed their fancy, newly installed computer programs could accurately price the risk of these new demographics. They placed blind faith in an algorithm over fundamental underwriting principles.
And the computers were dead wrong.
Dead wrong. Combine that arrogance with the sudden introduction of new no-fault insurance laws across various states, which meant GEICO suddenly had to pay out for their own drivers regardless of who actually caused the accident.
Oh, wow.
Yeah, the whole model shattered. The executives woke up in 1975 and realized they had underestimated their claim losses by a staggering $100 million.
Yeah.
They had practically zero reserves left.
So wait, by 1976, their stock had nosedived from $61 all the way down to $2. GEICO is basically a sinking ship taking on water far faster than it can bail it out. Wall Street is running away. Why on earth does Buffett look at a 97% stock drop and think, perfect time to buy?
Because he recognizes that while the management team had made catastrophic, hubristic errors, the core economic franchise, that low-cost direct distribution model, was actually still intact under the rubble.
It just needed the right person to dig it out.
Exactly. Enter Jack Byrne, the new CEO who Buffett later dubbed the Babe Ruth of insurance.
High praise.
Very. But Byrne walked into an absolute nightmare. To avoid outright bankruptcy and appease the regulators, Byrne faced a terrifying catch-22. He needed to raise $50 million in fresh capital and simultaneously get competitors to reinsure 25% of GEICO's massive risk portfolio.
Which, that's an impossible sell on both fronts. No reinsurer is going to take on the toxic risk of a dying company unless they see that $50 million in the bank.
Right.
And no Wall Street bank is going to hand over $50 million unless the reinsurers have already signed on the dotted line to stop the bleeding.
Yeah.
It's a complete Mexican standoff.
It was a vicious cycle of evaporating trust. Everyone is waiting for someone else to make the first move. And that is precisely where Buffett steps in. He meets with Byrne, verifies that Byrne intimately understands the need to return to the core franchise, and immediately buys over $4 million in common stock.
Wow. Just like that.
Just like that.
Right.
But the true masterstroke, the mechanism that actually broke the standoff, was committing Berkshire Hathaway to buy a massive chunk of a newly issued preferred share offering.
Wait, let's pause on that because the mechanics here are brilliant. He doesn't just blindly throw money at common stock. He demands a preferred share offering. Why? Because preferred shares give him a guaranteed dividend and priority over the common stockholders if the company actually does go bankrupt.
He is protecting his downside.
Exactly. But externally, it functions as this massive blinding green light to the market. Wall Street sees Warren Buffett, the ultimate rational actor, putting his money on the line. He essentially weaponized his own reputation.
He completely flipped the vicious cycle into a confidence virtuous circle. Once Buffett's capital and reputation were on the table, the reinsurers suddenly felt safe enough to sign the treaties.
And once the treaties were signed, the rest of the capital flowed in from Wall Street. GEICO was saved.
Saved and primed for what came next.
Right, because here's where it gets really interesting. Anyone who follows Berkshire Hathaway knows the word float. It is the holy grail of their entire operation. Float is essentially, it's the money customers pay up front for their insurance premiums.
Yes.
The insurance company gets to hold on to that cash and invest it, sometimes for years before they ever have to pay it out in claims. It's the liabilities make money virtuous circle. But what is truly fascinating about the GEICO deal isn't just that they secured float, it is the sheer velocity at which they compounded it.
And what's fascinating here is that the velocity was driven by Lou Simpson. He was brought in to be GEICO's investment chief. Buffett was managing Berkshire's overarching capital, but he gave Simpson total unfettered autonomy over GEICO's float.
Just let him run with it.
Completely. And over a 25-year period, Simpson generated an average annual return of 20.3% on that float.
Which is insane, because the S&P 500 averaged what, like 13.5% over that same time frame?
Exactly. When you factor in compounding over a quarter century, a nearly 7% annual outperformance creates a galactic difference in wealth. Berkshire essentially acquired a cost-free loan from GEICO's customers, and Lou Simpson compounded it at over 20% a year.
So by the end of 2018, GEICO had generated $15.5 billion for Buffett, all from an initial investment of $45.7 million.
It fundamentally shifted the architecture of Berkshire Hathaway. It gave them a perpetual, compounding cash geyser.
But having cash is only half the equation.
Right. You have to allocate it somewhere that beats the macroeconomic conditions of the era.
Which perfectly sets up the second deal. because in the late 1970s, the macroeconomic condition was rampant, double-digit inflation.
It was brutal.
Yeah, having a geyser of cash is actually a liability if inflation is eroding its purchasing power by 10 or 12% a year. You need to park that capital somewhere that can aggressively raise prices without losing customers. Buffett called this the unregulated toll bridge.
I love that term.
It's perfect. And in 1977, that meant buying into a seemingly mundane industry, print newspapers, specifically the Buffalo Evening News.
Because you have to remember, in a world before the internet, a dominant local newspaper was an absolute goldmine. If a newspaper achieves a local monopoly, it holds the keys to the city's entire commerce ecosystem.
Right, there's no Craigslist, no social media.
None of that. If a local grocery store wants to advertise a weekend sale, or if someone needs to sell a car or find a job, they have absolutely no alternative but to use the paper. It has overwhelming bulletin board value.
So because of that singular dominance, the monopoly paper can raise its advertising rates and cover prices year after year, easily outpacing inflation, and the customers simply have to pay it. Survival of the fattest, as Buffett famously quipped.
Yes.
So in 1977, Buffett and Charlie Munger buy the Buffalo Evening News for $35.5 million through blue chip stamps. But wait, I'm looking at the numbers from Buffalo at the time, and it contradicts his entire philosophy.
How so?
Well, his whole thesis is, avoid competition, yet he willingly drops $35 million into a city where a rival, the Courier Express, is already entrenched.
Heavily unionized, too.
Right. And not only that, but Buffett's paper didn't even have a Sunday edition, which is historically the most profitable day of the week for advertising. If Buffett loves monopolies, why buy into this mess?
Because he saw a pathway to a monopoly. But he knew it would require a brutal attritional war to get there.
He was ready for a fight.
Oh, absolutely. The rival Courier Express had a comfortable monopoly on the Sunday paper market. Buffett and Munger knew that to survive long-term and create that toll bridge, the Buffalo News had to launch its own Sunday edition.
Okay.
So they announced one. And they offered a highly aggressive introductory promotional price to readers.
I'm sure the rival loved that.
The Courier Express panicked immediately. They sued under antitrust laws, claiming the news was subsidizing the Sunday paper with their weekday profits to illegally destroy competition.
And the staggering part is the courts actually granted an injunction. The legal system severely hamstrung the news.
It was devastating. They were forbidden from offering the promotional pricing, and even worse, they couldn't legally guarantee circulation numbers to their advertisers.
And if you can't guarantee how many eyeballs will see an ad, you can't charge premium rates. It was a total disaster. For 5 agonizing years, the Buffalo Evening News just bled cash.
It was a massive drain. At one point, Charlie Munger sat down and calculated the sheer opportunity cost of the battle. He admitted that if they had never bought the paper and simply invested that initial $35.5 million elsewhere, they could have been generating $10 million a year in returns.
Just off the interest, basically.
Exactly. Instead, they were drowning in red ink, fighting 13 different highly hostile unions, and tied up in federal court.
But this reveals the underlying mechanics of how they won. It wasn't just about outspending the rival, it was about weaponizing quality while absorbing the pain. Because even while losing millions, they completely refused to compromise on the product.
Right, they kept their news hole, which is the percentage of the newspaper dedicated to actual journalism rather than advertising, at a massive 50%.
Well, the industry standard was what, barely 40%?
Barely 40. They essentially starved the Courier Express by relentlessly delivering a thicker, superior product day after day.
And they also held an absolute, unwavering line against the unions. When the unions threatened strikes that would halt distribution, Buffett and Munger told them point blank, "If you strike, we will close the paper permanently today and take the entire financial loss."
We will not negotiate.
And they never bluffed. It was a test of financial endurance, and Berkshire Hathaway had deeper pockets and thicker skin.
And in September 1982, the reality of that endurance broke the competition. The owners of the Courier Express realized Buffett was never going to quit, and they simply threw in the towel and folded the paper.
Just gave up. So Buffalo instantly became a one-paper town. The Buffalo News transformed overnight into the exact monopoly toll bridge they had envisioned. Within just 3 years of the rival folding, Berkshire Hathaway made back its entire initial $35 million investment.
They bought a flawed asset, willingly absorbed 5 years of intense multi-front warfare, and birthed a cash-generating monopoly. It is a profound lesson in delayed gratification and structural dominance.
Which provides a fascinating contrast to the third deal. Because we move from a brutal half-decade corporate war of attrition in Buffalo to an acquisition in 1983 that required almost zero negotiation at all. It was a deal built entirely on unshakable human trust and the sheer force of nature that was one single founder.
We are talking about the Nebraska Furniture Mart, and more importantly, its founder, Rose Blumkin, universally known as Mrs. B.
Her backstory honestly defies belief.
It really does.
She was an immigrant from Belarus who never spent a single day inside a classroom. She escaped via the Trans-Siberian Railroad, and she started the Nebraska Furniture Mart in a tiny basement in 1937 with just $500.
And she even sold her own home's refrigerator just to pay off her initial debts.
Just a relentless hustle. So what does this all mean? Well, think about the business world like an NFL draft. Buffett famously said that if he had the first overall draft pick and he could choose between the top 25 MBA graduates, the top 25 CEOs of the Fortune 500, or Mrs. B, he'd pick Mrs. B every single time.
Every time. Because she operated with a singular, unwavering philosophy. Sell cheap and tell the truth. And she didn't just sell cheap. She fundamentally dismantled the local retail industry's pricing structure.
The numbers are wild.
The historical data from the source shows NFM's actual 1946 financial numbers, and they perfectly illustrate her mechanism for wealth. She started that year with about $57,000 in net assets. Over the next 12 months, she turned that into $575,000 in sales.
But her gross margin was a microscopic 17.77%. Any traditional retailer looking at a 17% gross margin would think the business was failing. But the secret was her operating expenses. How do you survive on a 17% margin? You drive your operating costs down to an astonishing 14%.
Exactly. She acted as her own supply chain. She bypassed regional distributors, bought directly from manufacturers in massive bulk, stacked the inventory high in her low-rent building, and took practically zero salary for herself.
So because her internal costs were so lean, she was making a tiny 3% profit margin on each item, but the sheer relentless volume of sales she processed made the enterprise incredibly lucrative.
She was selling furniture so cheaply that the massive entrenched department stores in Omaha realized they couldn't compete on math. So they resorted to sabotage.
Of course they did.
They organized boycotts, threatening manufacturers that if they kept supplying Mrs. B, the big stores would drop their contracts. When she found workarounds for the supply chain, they dragged her into court, accusing her of violating fair trade laws, which were essentially designed to prevent pricing things too low.
And the resulting courtroom scene perfectly encapsulates why she was unstoppable. She stands before the judge and simply walks him through the math. She explains that her main competitor buys a specific carpet for $3 a yard and marks it up to sell for almost $8. She buys the exact same carpet for $3 and sells it for slightly under $4.
And she looks at the judge and says, "I sell everything 10% above cost. What's wrong? I don't rob my customers."
And it worked. The mechanism was so ruthlessly fair that the judge not only acquitted her on the spot, but he walked into her store the very next day and bought $1,400 worth of carpet for his own home.
It is the ultimate endorsement.
Truly. And her business model was battle-tested by a bizarre twist of fate later on, right?
Yeah, in 1975, a massive tornado ripped the roof entirely off their primary out-of-town warehouse.
Which sounds like a disaster.
It was, but they were forced to temporarily consolidate all their surviving inventory into one single gigantic location. That natural disaster inadvertently revealed a profound psychological reality about consumer behavior. They learned that customers are absolutely willing to travel hundreds of miles, completely bypassing all local competition, if they are guaranteed to find every possible selection at the absolute lowest prices under one giant roof.
That accident cemented the mega store model that defines them today.
It really did. Now, Buffett had wanted to buy the business for years, but it was a tightly held family operation. Finally, in 1983, when Mrs. B is 89 years old, she's getting annoyed with her family, the kids and the bums, as she called them.
Right.
She wanted to sell just to avoid inheritance fights down the line. So on his birthday, Buffett simply walks into the store. He doesn't bring an army of analysts. He asked her two incredibly straightforward questions. Do you own the building, and do you owe any money?
And she says yes, she owns it, and no, she owes nothing.
Exactly. So on a handshake, He hands her a check for $55.35 million in exchange for 90% of the company.
On a 1.25-page contract.
Yep.
Think about the audacity of that. He didn't conduct a forensic audit. He didn't send a team to count the inventory in the warehouse. No real estate lawyer spending months poring over the property titles. Just pure trust. He understood the economic moat she had built. He implicitly trusted her character. And he didn't need a spreadsheet to validate the operational dominance he could see with his own eyes.
If we connect this to the bigger picture, this highlights the ultimate hallmark of Buffett's management philosophy. When he acquires an exceptional business, particularly one driven by a generational founder, his strategy is absolute autonomy.
He just lets them run it.
He bought the company, but he left the founding family entirely in charge. He didn't subject them to endless corporate board meetings or demand they meet arbitrary quarterly expectations for Wall Street. By isolating them from the noise and pressure of the public stock market, he allowed them to focus purely on widening their low-cost advantage over the long term.
He buys the engine and then he gets out of the way so the engineers can keep tuning it.
Exactly.
Man, we have covered incredible ground today. We moved from the brink of bankruptcy to courtroom battles and handshake deals. And if we synthesize all of this, we've essentially extracted a core, highly specific toolkit from these 3 masterstrokes that you can apply. First, you look for virtuous circles, right? Like GEICO's low-cost, direct-to-consumer model that generates massive investable float. Second, you identify the unregulated toll bridges, assets like the Buffalo News that, once they're dominant, grant you the pricing power to outpace inflation.
Crucial in any era.
Absolutely. And third, you bet on unbreakable human forces. Operators like Mrs. B, who build unassailable low-cost moats out of sheer operational efficiency and integrity.
It is a phenomenal framework. But building on everything we've discussed, there is one final, almost counterintuitive thought I want to leave you with, drawing on the philosophy of Lou Simpson, the genius who compounded GEICO's float at 20% a year.
Okay, lay it on us.
Simpson achieved those astronomical returns through a strict discipline he called masterly inactivity.
Masterly inactivity.
Yes. He read voraciously, he analyzed constantly, but he traded very rarely. He made incredibly few decisions, preferring to hold a highly concentrated portfolio of exceptional businesses and simply let them compound. In a modern financial ecosystem that is entirely obsessed with hustle, with the hyperactive trading, daily portfolio updates, and the need to constantly be doing something, Simpson generated billions by sometimes doing absolutely nothing for years on end.
That is wild to think about.
So the question to reflect on is this. Where in your own life or your own portfolio are you over-tinkering? Where could you benefit from the profound, exceptionally boring superpower of simply sitting still?
Sometimes the absolute best action you can take on the construction site is to just let the concrete dry. That messy, chaotic blueprint to $1 billion doesn't always require constant revision. Sometimes it just requires immense patience. Thank you so much for joining us on this deep dive. We'll see you next time.